What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is June 5th of 2019. Well, folks, I hope you are having a great day wherever you are, and in today's video, we've got to spend some time emphasizing a very key topic, and that is the possibility that the Federal Reserve or the Central Bank of the United States may go about reversing its hawkish monetary policy and actually start to cut interest rates, providing economic ease for equity markets and other speculative areas. So what does this mean not only for equity markets going over the next few days and weeks, as well as cryptocurrency markets and the broader macro perspective? We're going to be discussing all of that as we go throughout the video right after our quick sponsor. So stick around.
CoinField app is the easiest way to buy and sell a wide range of digital assets in over 100 countries. Download the app, sign up, and get $10 free. Start trading using the top 6 currencies in the world.
All right, everyone, so let's go ahead and focus in on equity markets, because it's not only going to be important to get an idea as to what's gone on over the last month in regards to U.S. stocks, but also to show just how quick on a dime equity markets can change their tone when one simple variable is changed. And I'm obviously not making it a mystery, guys. It's in the title. It's a Federal Reserve rate cut. Yet again, more of the same. So let's go ahead and take a step back. As far back as April on the channel, if you guys watch the daily updates, which I highly recommend you do, and if you don't keep consistent with it, I recommend you hit the bell icon so you don't miss a video. But as far back as April, we were talking about how an ascending wedge was building in price. The market was showing us that a very significant event was coming up as we reapproached the highs in the NASDAQ, and that was the May 1st FOMC meeting. So the Federal Open Market Committee meeting. This is basically when the Federal Reserve comes to the table and tells everyone how they're going to conduct monetary policy in the next following month. What changes are going to come to two key important variables: interest rates. So are they going to rise it? Are they going to keep it the same? Are they going to lower it? Or the management of their balance sheet. Are they going to take on new assets to provide relief to equity markets and other speculative different areas of finance and financial markets? Or are they going to roll off assets? Are they going to sell on the open market? A mixture of things such as U.S. Treasuries or the toxic assets that they took on back in 2008 that caused the recession, right? So it's a whole balancing act that the Federal Reserve has to do, because they want to make sure to protect the value of the dollar, which basically, if they provide quantitative tightening to markets, which will be bad for equities, it provides a boost to the dollar, and vice versa. Sometimes they have to basically give up some of the purchasing power of the dollar, or the power of the dollar comparative to other currencies, in order to provide relief to equity markets, as we're taking a look at now. But taking a look back in April, we talked about how the global trend right now is starting to spark some fear, and the Fed did not have room to provide any more quantitative tightening. Even keeping interest rates unchanged and continuing to roll off their balance sheet would not be enough to keep markets going higher. It would mean that we'd have to go down. We talked about this in our newsletter, a chance for the NASDAQ to get relief if the Fed decided to cut rates and possibly talk about buying up assets similar to how Japan's central bank does. That would kick us into high gear, into new highs, going towards 10,000 in a matter of a few months. But the Fed didn't do that. They kept rates stagnant. And they're doing that in an environment where there's a whole mixture of global factors that are causing strain on equities. We've got a continuous growing fear in the China trade war between the United States. We have continued confusion with what's going on with Brexit, something that's been dragging on for years. And we also just had talks of the potential tariffs on Mexico. And this is all coming at a time where I think even the Federal Reserve realizes that they've used just about every weapon in their arsenal to keep markets up. We had a $64 billion pension readjustment where basically, some of the leading institutions that manage people's pensions went out and took all of the money that was in fixed income markets, so treasuries and bonds, things that provide a consistent yield, and put that into equities, and basically bought the dip in a sense with people's retirement funds in a market that's already gone dramatically up. Anyways, so they've used all these things, not to mention we all know, if you guys again have kept consistent with the daily updates, that stock buybacks and dividends have been the main proper of stock markets over the last year or two. All of that is starting to fade now because corporate profits are thinning out a little bit. We've started to see a decline in corporate profits over the last quarter or two. So all these things are coming in to provide a negative weigh down on equity markets. So the Fed has to do what is pretty much one of its last or second to last weapons in its arsenal, and that is going back and cutting the rates that it just added to the market. Okay, so this you can just see in the last few hours, guys, and we'll take a look at futures here. It's 7:29 a.m. in the morning right now, so the market isn't trading just yet. You can see what happened yesterday. We had a 2.72% rally in the Nasdaq. Absolutely crazy. And one thing I forgot to mention as well as another macro factor, there's been a recent probe on the tech companies. So you would think that the market wouldn't respond this positive, but it shows you just how much monetary policy plays in all of this. A huge probe on the tech companies like Amazon, I think it was Facebook and Google just had a huge recent probe, and it knocked off like $130 billion in valuation from the major tech plays. Well, came right back into the market, just like that. Bam. That's how important a Fed rate cut is. And you can see markets are still feeling the love, right? And the futures right now are trading at around 0.5%. I have no doubt it's going to carry towards another solid green day. And the reason why is because even though we have all these things coming into play, a Fed rate cut is very, very important. Monetary policy is the most important factor. I try to stress this all the time, guys. I know I'm probably beating a dead horse at this point for those of you who are the longtime Dash fans. But the monetary policy of not just the United States, but of global central banks as a whole is the most important factor in whether or not equity markets, this multi-trillion-dollar asset class on a global scale, hundreds of trillions of dollars, is going to go up or it's going to go down. And that is going to shape how global markets perform. If equity markets sell off dramatically, just like they did in 2008, you are going to see a huge way down on everyday people, on everyday economic performance, on jobs, whatever it may be, as well as where you might elsewhere be invested, gold, silver, cryptocurrencies, which we're going to talk about as we go throughout the video. So as we were going through here, what actually led to this talk of a rate cut? We haven't gotten one yet. Well, there's two things. One, the other day, Powell was giving a speech and basically kind of alluded to the fact that basically as an organization, we'll quote, "We are closely monitoring the implications of these developments for the U.S. economic outlook, and as always, we will act as appropriate to sustain the expansion." All right, so they want the continued expansion of the economy. They basically just tell it to you straight. They're basically going to do anything they can to manipulate markets to keep climbing higher. You can say it's we're just trying to make sure we want GDP to grow, or we want unemployment to go down. BS. They're catering into equity markets. There hasn't been any dramatic changes in what's going on in unemployment numbers. This has to do with the economic expansion of equity markets. And you want to know who's got their money in it? I'll give you basically a statistic. The bottom 50% of America owns 0.5% of all assets, property, stocks, you name it. Who do you think their interests are really for? Okay, we can get that off the table right away. But he wasn't the only one who alluded to this. We had some comments on Monday that came from James Boyard, who's basically the St. Louis Fed chairman, who basically came out and said that we may be in need of a rate cut soon. He's not the only one preaching this. And obviously, they should have done this back in May. Now, the Fed thought that they had played it smooth. Equity markets were kind of unchanged the day of when they made the decision. It dropped a little bit, but nothing too severe. And the dollar remained relatively strong. It beat out expectations in the sense that the Fed was going to keep rates the same, that they weren't going to cut rates. They should have done it in May, though, because it's finally coming to roost. We have all these macro factors coming into play. And we'll see, the Fed is going to try to play catch up. Right now, the probability on the CME group, basically probability of Fed, it's a measurement of basically determining whether or not the Fed's going to raise or cut or keep rates the same. It's still around 20% right now, but I can tell you when these numbers start to update, the probability is probably up more towards 40 to 60% for June. A lot of people are confident from yesterday. And whether or not this is going to be able to provide enough relief to markets is really the ultimate question. We're really going down. If we go down to, bringing back rates down to basically 2%, that's a reduction of over 39 basis points. That's going to cut us back down to all the progress we made through September, basically the fall of 2018 to today, if the Fed were to cut rates down to 2%. That's going to send pretty big shockwaves. As much as it's going to provide relief to equities, as much as this is going to be good, what this is going to send a signal as is that even though we might be able to revisit back to the highs of equities, maybe take a little bit more short-term speculation on stocks, this is going to start sending some very clear signals that, hey, we're getting towards the end of this game. The Fed is running out of options. The last two things that it can do is cut interest rates all the way back down to zero, right? The other thing that they can do is that they could possibly do what Japan has done, which is buy up actual equities and other types of assets outside of the kind of standard things such as treasuries and toxic assets like the mortgage-backed securities. So if they do that, I think you still got a chance of potentially a NASDAQ 10,000. And that means that we've got basically another 2,500 points to go. So in that case, if that happens, if we get a Fed rate cut and they do allude to possibly buying some assets up, yeah, I don't mind going long equities here. Sure, another 33% rally in markets, I'll take it. But you know what else I'm going to start preparing and bulking up for and building my strategies for? My hedging positions. I'm going to be keeping an eye on cryptocurrency markets and gold and silver. And we've seen with the price action that's been going on in gold and silver, I mean, take a look at gold over the last few days, guys. We finally are picking up an uptrend here. This is clear buy side activity. And it's after we were able, in this case, for the longer term trend, to be able to make previous resistance that weighed down price, a line of resistance here, new support. We rode on that resistance, and now we're curling back up. Gold has been killing it over the last 2 weeks. Really haven't seen this kind of performance in a while. And it looks like we're going to continue it with this obvious sign that, hey, we're increasing quantitative easing, we're lowering interest rates, we're going back to filling the punch bowl again. And that leads people to start to hedge, to start realizing in the grand scheme of things that the trend is shifting. Now, in the sense of crypto markets, I want to talk about this because I know it's obviously the most relevant topic here. We're a crypto channel at the end of the day. The major thing I want to talk about is as we're seeing this correction in Bitcoin, I do believe we're going to follow through with the correction. I think we're going to go through down to the low 6,000 range at a minimum. Okay, guys, we had a very exuberant rally. We went up, 3 times our base bottom value here for Bitcoin, near 3 times valuation increase from the lows. But I want to say that, we've only got a window of time until we revisit back up to the highs at 20,000. And why do I say that? This chart right here, or this little section of the chart that I've highlighted, shows us how long it took to go from the lows, the last low that we set in the market, all the way up to the previous highs of Bitcoin's rally back in 2013 into 2014. It took about 78 weeks. Okay, we're at 26 weeks right now, and at a current price of 7,800, going all the way up, in this case, if we mask what happened in history, all the way up to 20,000. What happens after that is really what I'm interested in, but I can tell you all in the preparation for what comes after that, which I think is going to be mass exuberance like we've never seen before, and crypto finally becoming recognized as a global market of currency and store value. I can tell you all, we don't have that much time. I feel this time things are moving, as we've already seen with the rally. The market's moving quicker. The macro picture is pushing the narrative for Bitcoin. It is finally showing us that Bitcoin will be the hedge to compare against all these markets, to basically be in a non-correlated asset that isn't tied into what's going on in the macro picture of things. In fact, if anything, if it's tied to it, it's the opposite. If there's growing fear in markets, if central banks are losing control of the big picture, then you'll want to be in something that's not correlated to that, right? So I don't want to do too much of a deep dive, guys. You guys know I'm looking for this to go down to 6,000, potentially rally higher. I think gold is finally looking optimistic. If you were to break above 1360 here with a solid close on the weekly, I'm definitely going to finally be bullish on gold, because that's an ascending triangle here. You can see we've been setting higher lows here. We've been, hitting this resistance range all the way back since 2013. If you break out above there, more specifically around 1,400 an ounce, I'm not too interested in equities at that point. That goes to show that markets are starting to fear some serious signs that the global economy is going to be seeing a shift very, very soon. And all these things compounding are not a good combination. It's a cocktail for disaster. And that's why the Fed has been on has been vigilant for so many months. We're very hawkish. We're going to keep interest rates at the same rate, if not increasing them at a steady pace. And we're going to keep on rolling the balance sheet. It's on autopilot. We're going to keep rolling it off. No longer. The Fed has changed tones. When Powell hints things like that, we need to listen, because he has to give some signs. He needs to give that kind of relief to markets. and say what he's looking to do over the next few weeks or months, whenever the FOMC meeting. So the FOMC meeting is going to be in less than 2 weeks. It's going to be, I think, on the 15th or the 16th of this month. You guys can look up that number online or that date and figure out for yourself and stuff just to double check. But I'd love to know what you all think about this. Do you think the Fed and central banks are finally losing control? Do you think they still have these two weapons? I still think they do. I think they could push the NASDAQ up to double of what it was at the dot-com era at 5,000 all the way up to 10,000. I would like to know what you all think, though. I've rambled on enough for the day. You've heard me talk enough, but I hope you all enjoyed this video, this macro perspective, as I like to give from time to time. And if you all enjoyed the rambling, not only consider dropping a like, subscribing if you haven't, but as I mentioned, please hit the bell icon. And if you guys haven't used the Brave browser or want to support me in various ways, you guys can donate to me through Brave, and also I got a lot of links down below to where you can help support the channel. But that being said, everyone, thank you all so much for watching, and I will see you all in the next video. Stay tuned.